Welcome back to the Deep Dive. Today we are digging into the nuts and bolts of the commercial real estate market. We're looking at what smart money is prioritizing right now in these first few weeks of 2026.
It's a really fascinating snapshot. Our source is a curated list of investment opportunities from Joseph Goslan and his team at Eureka Business Group, EBG. This is from January 10th.
And EBG isn't just any brokerage, right? They've been around since 2008. And they really specialize in guiding the exact kind of person who's probably listening to this. Retail investors, franchisees, business owners.
Especially in the Dallas-Fort Worth market. They know that niche cold.
Right, and that's key, because their message this week is really instructive. It's aimed right at the business owner who's currently renting.
Exactly. They're basically saying, look, now is the time to buy that building, put your business into your own asset. They see a window right now for that conversion from tenant to owner.
So that's our mission. We want to unpack this hand-picked list of best value assets and figure out the why behind each one.
It gives you this immediate insight into what experienced brokers are focused on. Are they chasing stable income, or are they hunting for that value add potential?
Okay, let's unpack this. The listings are all over the map: storage units, retail centers, raw land. We pretty much split them into two camps, right? Stability versus growth.
Stability versus value add. Clean, passive income on one side, and on the other, something that requires a bit of work to get the growth. A passive investor wants one, an active business owner often wants the other.
So let's start with stability. When people talk about passive income and CRE, they're usually dreaming about the triple net lease, the NNN.
The gold standard.
Fine.
And EBG has two perfect examples. First, there's an 8,500 square foot medical building in Hillsborough, Texas.
What's the appeal there?
It's built on three pillars. You have an investment-grade medical tenant, a really long operating history at that specific site, and of course, that NNN lease structure.
And the NNN structure is where the magic is for a passive investor.
Yep.
The triple net. That means the tenant pays the property taxes, the insurance, and the maintenance.
Right. Limited landlord duties. You're basically getting a check every month. It's much closer to a bond than a typical rental property. You're buying the tenant's credit, not the headache of fixing an air conditioner.
But is there any real upside then? Or are you just buying a low-growth bond in a high-growth state like Texas?
Well, that's the trade-off. The upside is the quality of the tenant medical services are essential, and just the long-term appreciation of the land. You're swapping huge immediate returns for extreme predictability.
Okay, so a slightly different flavor of stability is this 10,000 square foot retail property in Odessa. The tenant is Dollar Tree.
This one is appealing because it combines a corporate guarantee with brand new construction.
It was built in 2024, so it's fresh. And that corporate guarantee from Dollar Tree, that takes a ton of risk off the table compared to, say, a local mom and pop shop.
And here's the little kicker. EBG notes the rent is currently below market.
Ah, so there's your upside.
There it is. You have the stability of a new building and a big corporate tenant, but you also have this built-in expectation that when the lease renews, you're going to see a nice bump in your income. It's stability with a clear path to growth.
And to round out stability, there's a retail and medical building in Richardson, about 14,000 square feet. The key phrase here seems to be fully leased.
That does a lot of the heavy lifting, for sure. Plus, you have a heavy medical tenant mix, long-term tenants. It's just a solid, reliable asset in an established area.
Okay, so now let's flip the coin. Let's talk about the assets where you've got to roll up your sleeves a bit. The value-add plays.
And the classic value add is self-storage. EBG has a listing in Topeka, Kansas. It's an off-market deal, and the whole pitch hinges on one thing: expansion.
They explicitly call out expansion upside with additional land and pad-ready space. So you're not just buying the current business.
You're buying the ability to immediately build more of it. But here's the real strategic gem in the listing.
What's that?
No new competing supply within a 5-mile radius.
Oh, that's huge. That's a local monopoly.
It's pricing power. It means if you build more units, you're filling existing demand without having to get into a price war with a new guy down the street. It kills the biggest risk in storage, which is oversupply.
Okay, let's pivot to this 46,000 square foot retail center in Enid, Oklahoma. This one feels a little more complex. EBG notes it's well below replacement cost and has a short WALT.
That short WALT, the weighted average lease term, that's everything here.
Most people hear short lease term and they panic. They think instability.
But for a value-add investor, a short WALT is a golden opportunity. It just means the leases are coming up for renewal soon.
Which means you can raise the rent.
You can immediately renew those leases at today's higher market rates. Think about how much rents have gone up with inflation. This lets you catch up fast and boost your net operating income, your NOI, right away.
And there's another layer here, the potential to convert the leases from gross to NNN. Explain what that does financially.
A gross lease means the landlord pays for pretty much everything, taxes, maintenance, you name it. A NNN lease shifts all of that back to the tenant.
So you're not just increasing revenue, you're slashing your expenses at the same time.
Dramatically. You do that, and your NOI goes through the roof overnight. So the strategy's clear. Buy it cheap, convert the leases to NNN, get higher rents, and then you've immediately forced the value of the asset way up. That is pure value creation through management.
Let's focus in on Texas now. That's clearly EBG's home turf. Almost all these deals are in DFW suburbs or those growth corridors shooting out of Austin.
It shows they're betting big on that regional migration, and they're targeting these essential necessity-driven services for those growing populations.
Like this tiny listing in Plano, just 756 square feet for a medical or office user.
But look at the description. Prime West Plano location, ideal size for an individual user. And they even call out with an exclamation point, very affluent demographics.
So in these high-end areas, a small specialized space can be a goldmine.
Absolutely. The customer base is locked in. You're buying the neighborhood stability.
And on a bigger scale, there's another suburban necessity, a childcare facility in Burleson.
Textbook play. Burleson is a huge DFW growth corridor. When a population explodes like that, the need for schools and childcare often outpaces the supply.
And they mention limited competing inventory.
So this asset fills a basic, non-negotiable need for all the new families moving in.
Okay, let's talk about land. Two big land plays here. The first is about 2 acres of mixed-use land in Mesquite.
And this is where working with the city becomes so important. The zoning allows for serious density up to 84 apartments plus retail. But the key phrase is, city supports corridor redevelopment efforts.
So why does that city support matter so much for a developer?
It takes so much risk off the table. A developer's biggest nightmare is getting stuck in zoning fights for years. If the city is actively on your side, it means they want this to happen. It shortens timelines, cuts through red tape.
And I see they've added a sweetener here. Owner financing is available.
That's massive. Traditional bank lending for raw land is incredibly tight right now. That opens the door for a lot more buyers.
Then you have this monster parcel. Almost 38 acres of residential land in Cedar Hill. It's a CHISD asset sale.
Cedar Hill Independent School District. When a school district sells land, it's often a really clean deal. The titles are usually clear, no weird environmental issues. It was probably land they held for a future school that they don't need anymore.
And it's a sealed bid opportunity.
Right, so it's a competitive process designed to get the best price quickly. A fast track for a serious developer to acquire a huge, clean parcel.
Okay, let's wrap with the high-end retail centers. In the $2 to $5 million range, we've got a retail center in McKinney, right on Highway 380.
And Highway 380 is just a major, major growth artery for DFW. This property has all the good stuff, NNN leases, national tenants, and built-in rent escalations.
Which is non-negotiable in a hot corridor like that.
Yeah. You have to have it. It guarantees your revenue goes up every single year. We see a similar thing in Flower Mound, a stable center, but with a clear value-add piece by leasing out the empty second floor. You get income and upside.
And then we jump to the big leagues. The 10 million plus category, a huge retail center in Leander.
This one is a pure growth corridor play. Leander is one of the fastest growing suburbs of Austin. The center is new, it's fully leased with long-term tenants. I mean, you're just buying a piece of that explosive population growth.
So what does all this mean for our core audience? The retail investors, the owner users. The list isn't just for the big guys. EBG specifically flags listings under $2 million.
And this is probably the most important section, because this is where they adjust the biggest hurdle for small investors right now: liquidity and financing risk.
Take the medical office in McKinney. It's an exclusive EBG listing, and they highlight 2 things. It's selling well below county assessed value, and crucially, owner financing available.
Let's break that down. Buying below assessed value, what does that really give a small business owner?
It's like an instant equity cushion. If the county says it's worth $1.8 million and you buy it for $1.5, you've got a $300,000 buffer against any market dips on day one.
It's invaluable protection. And then the owner financing. Look, that's the solution to tight banks. It lets a franchisee or a doctor bypass that whole slow, expensive process.
And this particular property has 2 units, so an owner could use one for their business.
And rent out the other one immediately. They become a landlord on day one, and their tenant helps pay their mortgage. That is smart asset utilization.
We also see a multifamily deal in Dallas, a stabilized Class B asset in an infill Lakewood location.
Infill is the key word there. It means it's in an already dense, developed, desirable neighborhood, not out on the suburban fringe. There's less risk, established infrastructure, and a built-in tenant base.
It's a fully renovated asset, so the hard work is already done. You're buying stability and density where it's almost impossible to build anything new.
And this has all been brought to us by the team at Eureka Business Group, of course. Joseph Goslin is the managing principal. They handle investment sales, tenant rep, consulting, the whole spectrum.
So to recap this January snapshot,
Mm-hmm.
it seems like the smart money is betting on specific needs within these booming Texas suburbs.
Exactly. You've got the low-risk NNN income plays like the medical building. Then you have the high-upside value-add deals like the self-storage or that retail center in Enid. But the theme is always capitalizing on predictable needs: medical, childcare, discount retail, in these places where people are moving.
Absolutely. And that leaves us with a final thought for you to chew on. We've talked about stability and value add as 2 different paths,
Right.
but these listings with owner financing that are selling below assessed value, they raise a fascinating question for that owner user.
Mm-hmm.
When is the risk that sometimes comes with unique financing terms offset by that immediate equity you get, especially when the city itself, like in Mesquite, is actively pushing for redevelopment in that area?
That's the real question, isn't it? How do you weigh the potential weirdness of non-traditional financing against the immediate win of buying cheap and the long-term tailwind of government support?
If you can figure that out,
Yeah.
you're way ahead of the game.
That's the kind of insight that moves you beyond just reading listings.
Something to chew on. Thanks for joining us for this deep dive. We'll see you next time.